thank you very much for joining with us. Happy New Year. Glad everyone is here and ready to make some profits in the new year. We're going to be going over kind of a high level of what to consider with the market and what it's currently doing and the transition that we're going to be coming up with in the next few weeks, especially with an administration change, and also some of the alternative options that are available to you to kind of help to mitigate or maybe make an interesting change into some more diverse and alternative asset classes here coming up. My name is Alex Perny. I've been with Advanta since 2012. If you do have any questions, all of my direct contact information is listed right there on the screen for you. So if you have any questions, I do encourage you to reach out to me directly. I am always happy to help. A quick disclaimer before we do get started: Advanta IRA and our employees do not provide investment advice, nor do we endorse or promote any investment products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. Oh, sorry, going the wrong direction. A few key takeaway points that I want people to understand from this is that if you're looking to self-direct, or if you're looking to maybe change up some things, especially with self-direction, any IRA or former employer plan qualifies. You get to choose these investments. Again, this is not something that you have to pick off of a certain list. You're not beholden to just what's listed on the New York Stock Exchange. You get to have full and total control of everything. And especially if you are looking to get into the alternative asset space or start doing self-direction, any and all expenses related to an asset, which is something that people don't always understand, especially in the more traditional realm. You don't get you don't get a lot of bills when it comes to just investing in regular stocks, bonds, and mutual funds. At least nothing that kind of is addressed on the asset level. So with that said, again, understanding kind of how things are paid is also a very good thing to understand. A little bit about Advanta IRA. We have over 20 years of experience specifically and only in the alternative asset and self-directed space. We didn't start out as one thing and kind of dip our toes in and start migrating over to this space. We have always been focused on the self-directed and non-traditional asset space. And again, we're very proud of that fact. We have over $3 billion worth of client assets that are strictly in the self-directed and alternative space, which is something that, we're very proud of that growth, and it kind of goes to show the adoption and how these things can actually be used to quite a good degree of effectiveness when it comes to, diversifying your portfolio. And one thing that we're also very proud of here is that we have a direct kind of personal touch, whereas so much of everything when it comes to investing in your finances is so sterile and technology driven. We really kind of focus on that human touch here. Every single client that is a client of Advanta has a dedicated account manager here. We don't just kind of turn you over as a nameless, faceless account to us. You have direct access to call and talk and ask questions and get the answers to the questions that you need in order to make informed and effective investment decisions. And again, past just being able to contact us, we like to put a lot of our education out there for free. We have bi-weekly events. Of course, you're tuning into this webinar, which we're very grateful for. We also host a podcast, or I should say, I host our podcast here at Advanta with a wide range of interesting and available topics. Everything from investing in commercial real estate to yesterday, I talked to a gentleman about how to develop a franchise from a business concept. So a lot of great, interesting topics there. I really encourage people to check that out. And we also maintain an up-to-date blog as well, kind of focusing on different trends and market analysis. So again, if you want to get more information to try to be a more informed investor, we have a lot of great resources, and again, for the low price of free. So we do encourage people to reach out to that effect. And understanding kind of what we do is also important in this. A self-directed IRA, while different companies certainly maybe market things as self-direction, wirehouses saying that, hey, you can self-direct your IRA and buy stocks, bonds, and mutual funds. A self-directed IRA in the broader context of especially what we focus on is on clients being able to pick and choose their own investments that are outside of a stock market, with the potential to build tax-free or tax-deferred growth depending on the type of an account they have. So again, when we say self-direction, really that's kind of what we're focusing on. And again, most people kind of haven't heard about this concept of being able to self-direct things. Again, it's not the most common thing out there. A big number that I like to kind of look at is that roughly in the United States, as a rough estimation, there's about 37 to $40 trillion worth of retirement plan assets. That's a whole bunch of money that is, or in a value that is tied up in pensions and retirement plans and the like. And such a small fraction of that enormous number is actually self-directed. And that includes people that pick stocks, bonds, and mutual funds on their own direction as that kind of self-direction, accounting for maybe 4%, and then this part of the market, even a smaller percentage. But when you're talking about such big numbers, there is so much capital out there that is allocated towards these types of investments that it's a pretty interesting concept to look at. And this isn't something new. The IRS has allowed for people to pick basically any allowable investment so long as that the IRA custodian is willing to hold that for their retirement plan. Basically, there's just a few things you can't do. You can't buy a life insurance policy, you can't buy a collectible, and so long as that you're not dealing with a prohibited individual, which we'll get into here a little bit later on, basically they say, hey, the world's your oyster, and since 1975, you have been able to do basically whatever you would like within those constructs, so long as you have a custodian willing to hold those types of assets. So again, it's a very interesting concept that just a lot of people don't get exposed to, because the ease of use of going to a brokerage just to buy stocks, bonds, and mutual funds is just that. It's so easy that people don't realize that there are other options out there. Now, why people choose to self-direct? Again, it's a new source of capital. There is so much cash out there, especially if you are looking to raise capital, or if you are, again, just looking to get into other things. It is a new source of capital for certain types of investments. And again, leaning in towards especially the alternative side, which we'll get into all those different options here as well. Again, that new source of capital is a big beacon that people typically gravitate towards. Especially kind of what I'd like to flavor this presentation with is stock market fatigue. Now, over the past year, it's been great, but things don't always stay great forever. Again, it's the markets have cycles, right? They go up, they go down, and especially when we continue trending towards 52-week highs, the fatigue of that can be very well, again, identified. It's not necessarily just stock market fatigue of when things are doing bad. Things don't do bad forever. Things don't do great forever. So understanding, the fatigue, granted, it's significantly nicer to be fatigued of historic highs than it is of historic lows. But again, fatigue does play a factor into this, and that is why people choose to self-direct. And another big one is tax benefits. IRAs and retirement plans offer one of the greatest abilities for everyday individuals to create a great tax incentive. You either get to invest in a completely tax deferred manner, or you can potentially invest in completely tax-free growth with Roth IRAs, or a hybrid of both, even using things like HSAs. The ability to self-direct multiple different kinds of accounts, which we'll get into the account types here in a minute, also again offers a great degree of flexibility. And again, none of these accounts are simply married to being invested in the stock market. So again, tax benefits being first and foremost in a lot of things for people to look at. So when it comes to market updates, again, if anyone here, I'm assuming probably everyone here on this call is probably invested into the stock market in some form or fashion. And I'm not here to say that you shouldn't be. Again, we're not financial advisors. And I would wager to say that exposure to diversification does include investing in stocks, bonds, and mutual funds on the broader market concept. Certainly, we do have clients that fully believe that the tangible asset, the alternative asset, is the superior way to go. And again, if that's something you're interested in doing, all the better. But understanding that these markets, again, are going to be in flux, and what we're coming into, especially with an administration change, is kind of important to address and understand. So over the past year, again, we've seen pretty consistent rate cuts from the Fed of the Fed money rate. Now, that's good and bad from a few different perspectives, depending on what you're actually investing in. Good from the perspective that it could potentially have the effect of making certain assets cheaper, namely real estate, which is one thing that we really focus on here at Advanta, administering well over $1 billion worth of real estate assets for our clients. But it maybe hasn't had the persistent effect that we're looking for. And especially coming into the new year, the Fed has indicated that while they are interested in continuing rate cuts, it's not something that we're going to be seeing at the rate cuts are not going to continue at the same frequency or maybe amount that we have been used to. Now, again, that being good, but again, if you're looking at something from the perspective, again, myself included, just having money in a money market or a high yield savings, was pretty attractive. I mean, up into, almost 4.5, some places I even saw offering 5%. Those rates have certainly been, have come down quite a bit. So looking to do with uninvested cash and getting into something that maybe can offer some stable cash flow with high levels of security would certainly be interesting. Think of things like real estate, where you have, contractually obligated, consistent cash flow that you can receive from rents, or any other types of structures, whether that be like a commercial real estate syndication or the like. But again, with the interest rate market still being relatively high comparative to the past few years, again, we're starting to get back to maybe a little bit more of a stable point. But again, that definitely is going to drive people's decisions. Now, the stability of the markets in general, at least looking at what most analysts are saying right now, we should probably continue to see relative stability and, again, some appreciable growth. But when you're saying stability and growth, when you're already looking at 52-week market highs on most things, again, depending on what market segment, again, most of the large caps are typically doing, relatively high, trade pricing. That's not something that, again, that continues in perpetuity. So I alluded to thinking about things on a fatigue level. Again, you can get fatigued on either end of the spectrum. Things don't always last, don't always continue to rise, again, into the future and infinitely. So thinking about a time for change, again, especially when we are seeing good growth and good returns, is definitely something to look at when it comes to planning out. We still have markets that are growing, but we still have a lot of issues that are coming in. Jobs reports are still showing some growth, but maybe not as high as expected. We still have supply chain issues with geopolitical factors coming in, whether that be from places such as China or the ongoing conflicts with Russia. We have things that are continuing to affect the broader markets, maybe outside of our borders, that maybe still haven't matriculated to the final feelings here in the United States. Now, whether or not an administration change with different policies that might go into effect to help alleviate that, what that's going to look like, who knows? But one thing that we can all agree on, no matter kind of what part of the political spectrum you fall on, we are going to see a more than likely a pretty drastic shift in policy and sentiment coming in with the new administration. Now, that typically involves some growing pains. Again, we've kind of seen that going from the Trump administration into the Biden and now back into Trump. So again, the historical look at what has happened, again, can be effective, but with that kind of continuing cyclic effect, again, it's not necessarily well understood, and there definitely is some uncertainty to be looking at. And lastly, asset pricing coming in. Good times to change typically are not when things are at the very bottom. Making a change when you have made money at your current positions. Again, the prevailing sentiment of buy low, sell high being good. Again, asset pricing can potentially lead into a relatively effective way to make an administration. Now, again, to the political shift and pricing, the performance is great, but how long can the continued highs continue? That's anyone's guess. But again, leading into that, understanding that good times to change are typically when you've made money is something that I like to, maybe encourage clients to look at. Now, again, the policies that are going to be coming out hopefully are going to continue to stimulate the economy and maybe normalize a few things, especially when it maybe comes to the woes that we're feeling on the labor market side, because that has been kind of a consistent issue, at least with the pricing of labor coming into this new year, hasn't really dropped as much as analysts, at least from what I'm reading, have looked at. And again, interest rate reductions have certainly helped, but the CPI, the Consumer Pricing Index, is still not necessarily matching what the Fed was looking for. So drawing some comparisons for that, what does that mean? Again, it's hard to necessarily say, and I know it might sound kind of like I'm giving a bit of a high level nothing speak on that. But again, from what I've been reading and at least what I've experienced with my clients directly, is that there has been kind of a neutral balance on a lot of this. We hear reports that things haven't performed as well, but then you look at one side of the coin and stock markets are continuing to rise, while you're still hearing that there's still continued labor issues with regard to pricing and inflation. So it's a tough one. And with that kind of general flux and uncertainty, again, looking to something that might offer a little bit more long-term stability is definitely something worth actually looking at. So again, with regard to a market update, I know in previous years I typically like to do these at the beginning of the year. There really isn't big things to point at. General market optimism is good, which is nice. Coming into especially a very sharp change in a political climate, which we're more which we're most likely going to see, it's nice to see at least most analysts on the publicly traded side having a relatively robust degree of optimism about the performance of the markets. But again, coming into a year where it was hard kind of not to make money in the stock market, which was great for the broad course of any investor, again, how long can that continue? That's something that kind of gives me a little bit of pause when it comes to, at least certainly in my own portfolio as well, as to maybe saying, hey, you know what, it's a good time to kind of look into some different alternatives. And that's kind of what we strive to promote here is, again, looking at those alternatives, not saying that one thing is going to be better than the other, but helping people to understand that you're not necessarily beholden to one area of investing. Now, certainly you can derive diversity from the stock market, but you're still investing in the same asset classes. If you invest in a mining company that mines iron ore, and then you have stock in Microsoft, yes, they are about as different of a markets as you can invest in. But at the end of the day, you still own stock in publicly traded companies, and things can and will continue to affect markets on a very broad concept. Look at any large issue that we've had in the United States, whether that be some type of again, geopolitical acts such as the market shift when we had the Russia-Ukraine conflict. Again, it affected markets here in a very broad and uniform effect, and that was halfway across the world. Even if you were invested in different market segments, certainly ones that had a more vested interest over there were affected more than others. But again, you can kind of see the general draw, whereas large-scale conflicts and other things that might affect markets in a broad sense aren't going to really affect your rental rates on a piece of rental property. They're not going to affect maybe what you can charge on a promissory note, right? These kind of things don't have as much of a actual real-time pricing effect or cash flow effect that they do on these types of more tangible assets. And again, so transitioning a little bit from market updates into what we do and kind of the other alternatives that are out there, self-directed IRAs really offer a great option for people when it comes to wanting to diversify. Again, you can diversify to your heart's content, with the exception of some people you can't invest with and a few things you can't buy. But again, these are assets including basically anything to do with real estate, private stock, again, startup companies, people that are forming new LLCs for different types of investments, syndications, cryptocurrency. And the further ability to kind of fine tune exactly what you're investing in is also a great and powerful tool. Again, with the stock market, there certainly are some fine tuning you can do with different alternatives to just buying straight line securities, whether that be things like options, whether that be things like having different types of market orders, whether that's doing limit orders or things like that. Again, those are certainly effective, but you really get to kind of customize your assets to your liking and what really works for you when it comes to investing in these alternative assets. And especially with things like real estate, you get to determine how long you want to hold it, whether it wants to be maybe a rehab or a flip, if you want to have a certain rental rate, if you want to have a certain avatar of people that you're renting to. Again, there are laws and regulations that certainly affect how you can do that. But we have clients that do everything from luxury properties to Section 8 government subsidized housing, that do Airbnbs with these things. Again, you can really kind of customize your assets to your knowledge and understanding and exactly what you're looking to accomplish with that. And it's not just necessarily, especially with real estate, we have clients that lend money that can be the bank. We teach whole seminars on that as well, on the paper asset side of things. Someone just indicated private loans and mortgages is kind of an apt transition here for that. Paper assets are extremely popular with IRAs. From one, the security of the fact that your investment is tied to a lien on a property. And again, you don't necessarily have to have a lien on a property, you can do unsecured private notes to individuals. Granted, those are going to have a significantly higher degree of risk if you lend someone a personal note, but you can have mortgages. It can be a first position, it can be a second position. You can get into exotic things like wrapping your mortgages. There's a lot of interesting things you can do with that. And again, real estate offering such a wide variety of interesting options, not just in options, but also things like tax liens, tax deeds, option contracts, joint venturing deals. The paper asset side of things is a very attractive option for people to look at. One, from the fact that these are extremely customizable from, again, how often someone pays you, how much money you're lending out, what interest rate that you're lending out, again, so long as it's not at a usurious rate, and also to the effect of exactly what kind of goes into that. You can really customize what your rate of return is on these things with a relatively high degree of security. Again, making sure you get proper due diligence done, making sure that you have the correct people looking at this stuff and that you understand what you're getting into. Again, these types of assets can offer a very interesting avenue to people that are really looking to maybe transition out of the more traditional markets and into something that they can really have a lot of fine control over when it comes to that. And again, it's not just real estate. While real estate is something that we are very passionate about and doing, and by extension, our clients are very passionate about, which is certainly illustrated by how much of our asset under administration is real estate related, which is still wild to me to think that it's probably in the mid one point something billion dollars of real estate that we administer for clients. That's not the only thing. We have clients that get into all sorts of other interesting alternatives. And the thing I like to illustrate with this is that, well, not everyone, or I should say the majority of people are not stock market experts. The people that are our clients and probably listening to this call are, not sitting on a trading desk and doing fine level analysis of different market trends. People as a general construct understand some things very well, but the stock market, again, can be complicated for complication's sake for a lot of people. There certainly are people out there that are farmers that understand the concepts and the cash flows of farming, and we have clients that invest in farmland. We have clients that invest in timber rights. We have people that do things like lending money to movie projects, investing in precious metals, equipment leasing, forex, commodities, oil and gas. Industries that people may work in that understand very well. You can utilize your retirement funds to invest alongside these types of industries in a direct hands-on fashion, not just buying the company's publicly traded stock, maybe buying into oil and gas leasing rights, or buying gold and silver, or again, different partnerships with people. The alternative spectrum is extremely varied, and typically there will be a good fit for someone out there. So the different types of plans that you can use for these investments are, again, going to be the same kind that you can use for the more traditional market investing as well. We have traditional IRAs, Roth IRAs. If you have an inherited IRA, you can use that as well. Different types of savings accounts. So they are going to be health savings accounts and education savings accounts. Great time to especially look at the HSA. If you had changed over your healthcare coverage during open enrollment, you now have a new plan that offers HSA coverage. A great time to look at those. I love HSAs. I personally use an HSA and self-direct my own HSA. I know it's a bit of a soapbox for me, but HSAs are incredibly powerful and underutilized. While traditional Roth IRAs, solo 401 or 401ks, SEP IRAs typically all gravitate towards just being invested in stocks, bonds, mutual funds, and again, the majority of our clients here at Advanta doing their self-directed investing. The majority of people with HSAs just have them sitting at a non-interest bearing account at a particular bank just to use for different medical expenses, which again is the primary benefit of them. But being able to invest in HSA really starts to magnify the benefits of those plans, where you get the tax deduction going in like a traditional IRA, you get the tax-free distribution for qualifying medical expenses on the back end like a Roth IRA, and once you're 65, you can treat it as a tax deferred account like a traditional IRA. So again, HSA is awesome, really like them. But again, these are all the different types of plans that can potentially be diversified out of the market, or again, self-directed in general, if you're interested in looking at that. So again, kind of at a high level, traditional IRAs are going to be kind of the most common account type that most people look at. Whether you had an old retirement plan from a previous employer, it's pre-tax. Traditional IRAs are by far and away the largest market segment of retirement plans for individuals out there because they mesh up really nicely with 401ks, 403bs, governmental 457s, TSP for armed services. All those things that have pre-tax dollars going into them can be rolled directly into a traditional IRA once you've severed employment. So again, it offers a tax deduction going in, so you get to write off the amount of the contribution on your current tax bill, tax deferred growth, so you pay taxes on the way going out. And again, anything that you're investing in, whether that be real estate, stocks, bonds, mutual funds, precious metals, oil and gas rights, any of those things that generate revenue into any of these types of accounts are non-taxable at the point of realization of that income. So you don't have to necessarily worry about any type of taxation. You can really drive that compounding interest of these types of plans at a very high rate to a great effect. And again, really the main difference to look at for a lot of these things is really just the tax benefit on the back end and the tax liability on, or sorry, the tax benefit on the front end and the tax liability on the back end. Again, whether or not you're getting a deduction and whether or not you're paying taxes. The Roth IRA is the reciprocal of the traditional IRA. You get a tax deduction, you get no tax deduction going in and you pay no taxes going out. A lot of people would agree that paying no taxes is better than paying some taxes. And again, I think most of us would probably typically not argue that point. But again, Roth IRAs aren't for everyone, and you don't have to have a Roth IRA to self-direct. That's something that I don't know where that came into the ether of people thinking about self-directed IRAs, but probably at least once a month, I will have a conversation with someone that says, hey, I'd love to do this, but I don't have a Roth IRA. Well, just like you don't have to have a Roth IRA to invest in Microsoft stock, you can do it with a traditional IRA, a Roth IRA, a SEP IRA, a simple, any of those things really. It's the same thing with here. It's just a matter of kind of what you have. Now you can do conversions, you can get money into Roth IRAs. Some people think that just because they make too much money, they can't have a Roth IRA. Again, not true. We teach classes directly on how higher income earners can have Roth IRAs. And again, completely above board. There's nothing wrong with that from the IRS's point of view. It's just some proper steps you have to follow for that. And again, a really big benefit of Roth IRAs is no mandatory withdrawals. Now, if you're a self-employed individual, you can also self-direct your personal retirement plans for those, like SEP IRAs, simple IRAs, solo 401ks. So if you are a self-employed individual, owner-operated business, there are options out there for you as well. It's not just the traditional and Roth IRAs, which again have significantly lower contribution limits. And just because you don't work for a large conglomerate doesn't mean you can't take advantage of significantly higher contributions to these types of plans. Planned contribution limits for the year of 2025 are listed right up here. Not much has changed. We got a couple of $500 bumps here and there, a few $100s on the HSAs here, but again, most everything has stayed relatively the same. And again, now's a great time to look at making contributions. With it being the first of the year, you can make a current year contribution and a previous year contribution. So individuals maybe that were a little bit short for an investment, coming up, I'm dealing with this with a few different people, have the ability to make a 2-year contribution amount within the span of a few weeks. So again, a really great time to kind of look at your contributions, especially now that we're after the first of this year. You have the ability to kind of double up on your contributions for making a previous year and current year contribution. And keep in mind, the contributions for traditional and Roth IRAs are going to be based on your timely filing deadline, not an extended one. SEP, simple, and solo 401k contributions, you do have until your extended filing deadline up into October to make those contributions if you filed for an extension. Contributions and earnings, again, the earnings are going to be unlimited with an IRA. And especially if you're listening to this webinar, again, looking at the kind of comparative analysis between traditional markets and the alternative space, again, you should probably understand that you're not limited by earnings. You're right, you can buy, sell, trade stocks, again, to your heart's content, and there's no limit on your contribution amounts. For whatever reason, and again, I'm not sure if this is just for where this comes from, but I have people say, oh, well, if I invest this $100,000 and it makes, 10% ideally, well, that $10,000 that comes into my account, I can no longer make a contribution. Again, earnings are unlimited, your contributions are. So the money you put in out of your own personal cash and your reserves, that is going to have a limit on it per year, depending on the type of an account. Could be down in the $7,000 to $8,000 range, or up as high as $70,000, depending on the different types of plans if you're self-employed potentially. But again, your earnings are never going to be limited. And again, you get to choose the investments. You are in full control of this ship when you self-direct, which is a pretty cool concept. And now some rules to understand, especially if you're coming from the more traditional world of investing. There really isn't any way that I've been able to think of where you kind of run it up against the rules of IRAs at a very granular level. If you're just going to invest in, Microsoft, maybe some McDonald's, ExxonMobil, whatever it is, you're never going to really run up against prohibited transaction rules. So what these look like, again, if you're looking to make the transition, you have to understand some rules. There are certain things that you cannot buy. You cannot buy anything that derives its value from collectability. Think antiques, rare bottles of wine, artwork, stamps, rare coins. Coins can be allowed if they're traded on their bullion content values, like a gold American Eagle, a Swiss Pamp bar, things like that. You can hold within an IRA. But again, you're not going to really ever run into those things in the traditional sense. And then prohibited transactions, and this is really where people don't ever get exposed to it. So there are certain things that you cannot do. You can't buy or sell anything to or from yourself. And again, I have a good I think infographics word that on the next slide that kind of illustrates who you can and can't deal with. But there are certain people you can't have your IRA transact with. Think you can't sell a piece of property that you own to your IRA. You also can't sell, like maybe if you own private stock in a company, you can't sell that to your IRA. IRAs can acquire these things at arm's length, and that's the general construct that will keep you out of about 95% of the issues with IRAs, is staying at arm's length from your transaction and not investing in anything that's prohibited. So no life insurance, no collectibles, and don't deal with anyone that is within an arm's length of your transactional basis. You'll be just fine. Again, we're here to help answer all your questions. That other 5% can get kind of murky. So again, let us know. We can happily navigate you through that so that way you can do your research and make sure you understand if you're doing does or doesn't kind of come up against any rules or maybe cross any lines. And the last one is IRAs can be exposed to some taxes. Potentially. Again, this is a very kind of unique scenario insofar as that if you are going to invest in something that has debt leverage, IRAs can be exposed to taxes. If you're going to be investing in owning a active trader business, the example I like to pick on is if your IRA were to go out and buy a laundromat. And that's where kind of a lot of people think. They're like, hey, look, what if I bought something that just made a bunch of revenue, right? I'd never have to pay taxes on it. Well, the IRS kind of is a little bit wise to that, if you will, as much as we maybe wish that they weren't. But if you own something, let's say like an active trader business, so you have your IRA, it buys an LLC that operates a convenience store or a laundromat, the IRS is going to say, hey, look, this tax shelter owning that active trader business needs to kind of be brought onto a level playing field with everyone else. So they're going to levy a tax to the revenue on that. And the debt financing one is a little bit more complicated to get into. I actually do teach a webinar specifically on that. I'll be doing that in I think about a month. I'll be teaching the unrelated debt finance webinar, which is a really cool one. I get really interested in kind of the minute taxation on that. But again, there are some instances whether the broad concept is if you invest in an active trader business or if you invest in something that has debt financing associated with the acquisition of whatever it's doing, can expose the IRA to taxes. I just had a really interesting question. It says, how about a winery outside the US as an alternative investment? Sure, you could definitely do that. There's nothing stopping you from doing that. It kind of depends on how you'd be doing that investment. I've seen plenty of clients invest in real estate outside the US. Now that asset as a broad concept could be a bunch of things. It could be private stock in the operations of it. It could be a loan potentially to that winery. Again, there's a lot of different ways you could do that. You do not have to just look at investing within the borders of our country. You can buy things that are physically located outside of the United States. Again, the only kind of exceptions to that is that you can't invest anywhere that's on a State Department watch list. So, again, think countries like North Korea, Iran, places like that. You can't directly deal with places that have State Department sanctions, which again, I don't think a lot of people would probably necessarily want to invest their retirement plans at. But again, the world is more or less your oyster. We have clients that invest in Southeast Asia and Singapore, Central and South America, in throughout Europe. I don't know if I've ever seen anything come across my desk. I'm sure we have clients that are invested in Africa and different countries over there. But again, winery outside the U.S., sure, I would love to see what that looks like, but that certainly wouldn't be a problem to do that. But let's actually draw that into the context of that same winery question. Again, that could be fine, but if your, let's say, parents own that winery, couldn't invest in it, the disqualified persons that you cannot directly deal with are kind of listed right out here. Essentially, if you look at your family tree, look directly up and down, you cannot invest directly with these people. Now, that doesn't mean you can't partner with these people. Again, and we'll get into that in one of the case studies I'm about to show, but you can't buy or sell anything to these people from your IRA or to your IRA. So if your parents owned a winery, let's say, you couldn't invest your IRA into that. Conversely, let's say your IRA wanted to buy a piece of property and rent it out to your children that are maybe going to college. You couldn't do that. So the IRA, again, has to stay at a acquisition and sale arm's length from any of these individuals, and from a utilization standpoint as well, has to stay at arm's length from these people. So that's the big one that a lot of people don't ever get exposed to in the more traditional markets. That definitely is something that comes up a lot, especially with things like real estate or lending people money, investing in different projects. Again, people know their families better than they know anyone else, so it would wager to reason that that is kind of why that happens. But again, very important to understand, because this is probably where most people get hung up with self-direction, is the disqualified individual rules. Again, you are disqualified from directly dealing with your IRA, and so is anyone directly up and down from you in your family tree. Now, the big one that people always kind of scratch their head on is brothers and sisters are not considered disqualified. So you can buy and sell stuff to your siblings, your cousins. Again, those are just fine to deal with. I don't know why the IRS allows for that, but they certainly do. Another few rules is that you have to have a custodian or trustee for your IRA assets, and they have to be approved by the IRS. You can't borrow from IRAs, and you can't pledge your IRA's collateral for any purpose. Those are, again, some of the more tertiary things that people run into, but they are certainly important to remember, especially when you start getting into things that maybe lend themselves to these things coming up. Again, important points to remember so you don't kind of run afoul of the IRS in this. Again, things to avoid. You can deal with siblings and, again, adjacent family members, but you need to do it on a fair market value. Again, the IRS would probably have an issue as if your brother owned a piece of real estate and sold it to you for 10% of market value. Now, I don't know any siblings that might be willing to do that for their siblings, but again, it's something to consider, is that if you're going to deal with people in your family that maybe aren't prohibited, you need to be doing it on a fair market value basis. Using a middleman between prohibited individuals by, let's say, hey, I own a piece of property, I'm going to sell it to my brother or my neighbor, and then my IRA is going to buy it. It's step transactions. Think about it kind of like a straw transaction. Again, that kind of structuring is not allowed as well. And again, lending, if you can't lend to a disqualified individual, lending the money to John to lend to Jane, if you will, just to kind of skip the steps to separate it. Again, the IRS does take umbrage with that, so think on that. So with all that kind of looked at, let's take a look at two case studies. It's easy enough to understand kind of how this stuff works at a high level of saying, okay, well, maybe it's a good time to transition out of the stock market, take advantage of some of these 52-week highs, and let's look at some other stuff. Okay, great. Buying real estate, awesome. Most people understand that, but at a functional level, how does it work? How does an IRA buy real estate? This is not the concept of like buying a REIT, if you will. That certainly is a type of asset structure that will get you invested, quote unquote, into real estate. But what we're talking about here is really more of a boots on the ground, hands-on. The IRA actually can own, deed, and title to a piece of real estate. So how does that work? So in this case, Susan wants to use her $50,000 rollover IRA to purchase a $40,000 piece of undeveloped land. Easy enough concept to wrap your head around. So who does what? Susan opens and funds the Advanta IRA. She finds the investment property. She makes the offer to purchase the land. She completes all of our documents and then reviews and approves all documents. So what do we do in this scenario? Kind of what value do we add to this besides obviously allowing for this type of transaction to happen? Well, again, we make sure that everything is properly documented and structured and then record kept and reported, so that way this stuff can stay compliant. So we work with the closing agents to ensure that all proper titling is done on all documents. We sign all documents on behalf of the IRA. We wire the $40,000 to close, and then we hold deeds and any other ancillary documents like a buyer's title policy, anything else like that. And then we receive all the income and pay any expenses. So after close, what happens? All expenses such as insurance and taxes are paid by the IRA. Again, for undeveloped land, you probably don't have a whole lot of expenses besides maybe just taxes and insurance. If there is some type of utilization of the undeveloped land, again, undeveloped land I see typically being used as either maybe some timber rights. I've seen people sell hunting leases on undeveloped land. Again, there's still definitely things to do with it. Now, for the same example, let's say that there was a house on that property. Well, in that case, the IRA would be signing any type of rental agreements or leases. Any income would come back to the property. Any expenses for the upkeep of that property, again, would have to be paid by the IRA as well. And then the purchase documents, again, how the title in public record would read would be Advanta IRA for benefit of Susan Smith IRA 1234. Let's see, question here. When buying a long-term investment, such as a winery or other property, et cetera, how would mandatory distributions and 10-year inheritance requirements work? Well, there's kind of a few things to look at that from that perspective. So if your IRA bought something, again, let's just say it's a traditional IRA in the sense, and you're buying a long-term investment. Well, if it's a pre-tax IRA, once you get to the age of 72, you would have required minimum distributions. Again, up until that point, pre-tax IRA, the liquidity of the investment is a moot point, but the closer you get to that age of mandatory withdrawals, you do have some considerations. Well, if the asset is cash flowing and you calculate your required minimum distribution and you have enough cash in the IRA that holds that asset to satisfy it, great. Another thing people don't realize is that a required minimum distribution is an aggregate calculation of all of your pre-tax retirement plans. So if you had an account, let's say at a more traditional brokerage, you had the traditional IRA here, you would add those values together to get your total required minimum distribution. And let's say you're more liquid over at your brokerage, you could satisfy the RMD for all of your retirement plans by taking a singular distribution. It doesn't have to be taken from each individual IRA. But in the case of this, let's say this was your only pre-tax retirement plan. If you had cash flow commensurate to distribute, great. Now, I think more towards what you're leaning in question of asking is like, hey, what if you don't have the cash there? Well, all is not lost. You don't have to sell or liquidate that position. You can distribute a portion of that asset in kind. Now, that does add some complexity. You would need to have a appraisal. You need to verify the value of that total asset. And then the fracturing of your ownership in that asset looks different depending on how it's structured, right? If it's, let's say, a private stock ownership or like LLC or limited partner interest in, let's say, this winery, then you would just distribute the number of shares that would be valued appropriately to satisfy that required minimum distribution, and then you would personally own it, right? So that's one way that could be done. Let's say it was more of a direct real estate ownership, right? There's a deed like in this piece of undeveloped land. Well, a portion of that property could be deeded to you, and you would then just have a tenant in common ownership of that piece of real estate. Now, further to that, you did ask about 10-year inheritance requirements. So let's say that you pass away, and then your heirs have a non-spousal beneficiary has to deal with this account that maybe has an illiquid asset in it. Again, same options come up is that with the 10-year distribution requirement, you can either at a high level, you either don't take any distributions for 10 years, deplete the entire account, and just distribute everything. And again, you don't have to liquidate, but the assets would need to be assigned out on the 10th year. You could take everything as a distribution up front. Most people don't do that because it'd be a big tax bill. Or you could split it into equal substantial payments over 10 years. And the same concepts hold true. If there's cash in the account, just deplete it equally over 10 years. But if there are assets in there, then those assets would need to be amortized over 10 years. So that way on the 10th year, the finalization of that distribution would be matriculated. So There's kind of a lot to unpack there. I try not to go too far in the weeds, but again, that's as high level as I can get without getting real complex with it is kind of the answer to that. And next question before we move on, can you explain why that example isn't self-dealing? I may be a little confused. Maybe if you could give me a little bit more context, I'll come back to that question. And maybe got a little bit past what you were looking at there, but happy to address that. If you can just give me a little context on the example. So again, undeveloped land, you can use it for making money. If you don't want to just let it sit there, again, to the same problem that we're seeing with the reduction in interest rates, especially high yield savings and things like that are getting less attractive because making 3.75% on your money as opposed to 5, I mean, you're barely beating inflation if you're beating inflation at all, with just having funds sit there. Same kind of thing. If you just have a raw piece of land that's not making any money, well, yes, you have a tangible asset that you can always sell and hopefully make some money on. But again, it's not cash flowing. It's not really gaining in value per se too much. Again, undeveloped land typically doesn't. So how do people make cash with that? Again, there's not a house there to rent. Or you could grow timber. You could rent it to a farmer. Put on storage unit, you could develop it. People put mobile home parks on these things. You could sell mineral rights if there were minerals to extract and exploit on that property. You could sell mineral leasing rights if you own the mineral rights to the property. So again, a lot of things you can do with undeveloped land. Again, I think it's a good primer without kind of getting fully into what it looks like to buy property is kind of a good way to, again, prime people for the understanding of that. Now, the next one I want to do is private lending. This will kind of bring us in for a landing because private lending is probably the most popular use right now with our clients that aren't buying into maybe kind of a syndicated commercial real estate deal, just with how expensive property has gotten, right? The average home price in America right now being almost $415,000, $435,000, depending on your market, which is wild to me. But again, lending money is a very popular route because you don't necessarily have to have all the money to buy a property. Someone might only need a certain amount of money, and you can certainly fill that gap. So here, Andrea and Steve's joint venture on private lending. So Andrea has 100 grand in an IRA and is interested in partnering with a rehabber to flip a house. She meets Steve, local investment meetup. He's got a project that needs some funds to get it across the finish line, right? Does your due diligence. And Steve agrees to use the collateral and some of his own funds as a down payment for the property. And Andrea agrees to lend him the rest of the funds. Again, she didn't have to have the whole purchase price, and maybe he has a lot of down payment there, and he's just looking for, again, somebody to get him across the finish line of being able to do this. And the loan can include, again, whatever you feel is in the best interest of what you're doing. But in this case, Andrea is going to fund the purchase and the rehab of the property. One of the really cool things, and the reason why I kept this in here, is your ability to really create exactly what you want with a loan. Whereas with the stock market, you're kind of beholden to the market factors, what's driving the markets, who's sitting in the seats of power, whether that be the CEO or the president of our country. Again, you're not kind of beholden to things that are completely outside of your control. Now, again, the past year that's been doing pretty good for us. Left, right, and center, I guess, it's been pretty hard to not make money in the stock market. But with private lending, especially, if you're looking to get into something, I would encourage people to really do your research and see if this might be an avenue you're looking at, because you get to determine how much you're lending out. You determine the interest rate. Again, they can't be usurious. You have to make sure that you are abiding by any regulations and laws that govern how much money you can charge on these things. You get to determine how long you want to lend them the money. You're not just locked into saying, hey, it has to be a 15, 30, 10-year, 5-year loan. If you want to lend someone money for 10 weeks, or if you want to lend someone money for 297 days, you could do what you want to with it. Again, you need to make sure it's a good fit for you. But the point I'm trying to illustrate is that you get to customize every single thing about this to make sure that it's, one, going to be doing what you want it to do and a good fit for the person that you're lending the money to. So the AM table, prepayment penalties, equity participation, if there is any, lender's fees, late payments, points, anything that you want. You can kind of, again, customize these things to a very fine degree and make it a very, attractive option for people that have IRAs to do. So in this case study, Andrea is lending 100 grand at 5% interest. She also has written in there that she gets a third of the profits at close as well. Again, you can customize these things very, very effectively. It's a 2-year balloon note, and the monthly payments are $420, and she has a first position mortgage on the property, meaning that if Steve fails to repay that loan, the IRA can foreclose and then would own property, right? You have that security, just like the bank that holds the mortgage to the houses that you might be sitting and listening to this webinar. You can have your IRA be the bank and have that high degree of security in your investments too. It's just a matter of understanding that the options are out there for you. So what does Advanta do in this process? Andrea's attorney prepares the note and mortgage. She approves all the documents, completes all of our forms, and then we fund the note. Now, what does this look like when it comes to fruition? He's ready to sell, sells the property for 130 net after closing costs. Gets the payoff from Advanta. Andrea kind of reviews everything and makes sure it's good to go. So what does this look like in culmination? The repaid principal is $100,000. She had a $2,500 in monthly payments. 10% of the profits of 30,000 is, or 10% of the total profits is, or the 10% of the profits at sale was $10,000. The total earnings for this investment over 2 years is $12,500. So 12,000, the repayment along with everything being 12,500. You can see how it kind of, I think I need to adjust that, had the wrong figure down at the very bottom. But again, in this scenario, having 12.5% return over 2 years with a high degree of security on a particular asset, again, I think most people would find pretty attractive. And again, it doesn't necessarily have to be real estate that uses collateral. I've seen people have UCC filings against large commercial equipment. It could potentially even be secured by a prohibited investment, such as a life insurance policy or collectibles. You are going to definitely run into issues if you have non-payment and have to foreclose. Like, what does that look like? But again, it does offer, again, some more flexibility. It can be secured by stock in a company. Again, stock portfolios can be used as collateral all day for a note. So it doesn't just have to be real estate that secures a piece of secures a promissory note. If you have someone that you want to lend money to that you can make money with that has something other than real estate, again, it is your discretion as to how that runs. And to that point, again, just understanding that there could be some additional things that come up. And again, this does very much lend itself to people that might be short on funds for purchasing real estate. Especially if you maybe are even short on lending someone money. Loans can be easily partnered with. And we do whole presentations on how to partner with disqualified individuals as well. So you can potentially partner with your IRA to bring those funds up for a loan. And again, you can do the same thing with real estate and other assets, but it's a little bit more complicated. Loans, the nice thing about them is once you lend the money out, money just comes back in. There's basically no expense ratio to it unless you have to do some type of foreclosure action. Basically, once the money goes out, you don't have to pay taxes, insurance, those kind of things. There's no ongoing expenses. It's just money coming back in. Again, the examples kind of write themselves for that. If you do have any questions, again, that's kind of towards the end of our presentation. I have a few more questions here. Okay, great. Got some questions. So one question is, why is mini storage okay in the laundromat UBIT violation? Well, it's not necessarily. I mean, you can invest into a laundromat, right? That is perfectly fine. You just would maybe have a UBIT liability. Mini storage, again, you can definitely invest into it, but depending on how these things are structured, let's say with a mini storage, you have invested into a limited partnership that is going out and developing mini storage units. And the basic way that this is run is maybe they have an operation company that operates it that doesn't bleed over cash flows. And I've seen this play out. I'm not saying this is the right way to do it or not, but just kind of to illustrate the points of exposure to potential taxes. Investing in mini storage could potentially definitely drive a UDFI or an unrelated debt finance income liability, not a UBIT liability like a laundromat would. Because if you're investing in the acquisition of the property that maybe then in turn just receives in rental income from its investment in the property, again, there's a lot of different ways mini storage can be played out. But again, it's not prohibited on either side of the coin to invest in an active trade or business. But if that mini storage maybe has debt financing associated with the acquisition of that real estate, you'd have a UDFI liability or a debt finance income tax liability. Again, both are perfectly allowable, but both certainly might have some type of debt finance liability there as well. Let's see. Please explain the example of self-dealing that is prohibited. I am confused self-dealing with thinking that I can't invest in my own property purchase like Susan did in the example. So in the example, so let's go back and make sure kind of everyone understands. So in this case, again, Susan is buying a piece of undeveloped property. It's not her piece of real estate. This is arm's length. Let's say it is, John Smith, that's just a random property owner in her county. In this case, again, she's just using her IRA to purchase. She's not buying it from herself. Self-dealing would be, let's say if Susan in this example owned the property directly, like she personally owned it for many years. And then she says, hey, you know what? I want to have my IRA buy this for me. That would be self-dealing. Now, to your extent, again, if you, for the gentleman that asked the question here, if you own properties or you own something else, you couldn't then just, sorry, got a forward call. You couldn't just buy something you personally owned, or you couldn't buy something owned by another disqualified individual as well. So I hope that answers your question. And then last question we got here so far, is there a template with all the terms when structuring a private money loan? There are many, many resources out there. There are a bunch of great people that we have worked with throughout the years. People like, again, if you look through our webinar series, the resources on our website, there are a ton of great resources out there. People like John Schaub or Pete Fortunato have been big in the self-directed IRA, real estate, private lending space for many, many years. Bill and Kim Cook are another great example. Those are some good, easy resources to look at. They have a lot of stuff out there. Some of it's free, some to pay for. And again, if you just kind of look at, note terminology, private lending terminology, you can find some resources there as well. And again, our database on our website as well, to kind of, again, bring this in for a landing at the end, like I like to do. Everything that we do is always cataloged on our YouTube channel. So if you just search private lending on our YouTube page, again, you will find a ton of different great guests, different resources, stuff that we have taught on specifically for IRAs, people teaching specifically more towards how to do this stuff. And again, all free. So I definitely encourage you to look at it. Again, we do have a podcast and a blog that we keep up to date. So again, check those out. And if you're ready to get started, you want to learn more about it, again, this stuff is really easy to do. Opening an account, rolling over funds, and finding an investment in the self-directed space. It's really not a terribly complicated process, and we're very happy that we've built systems that can effectuate that. So with that said, again, I'll stick around for a few more questions if there's people that want some more information. If you want to, kind of chime in if I didn't maybe address something as well, or you kind of have something else that you'd like to get some more information on. Or you can certainly always email me directly, give me a call, happy to help. And if you would like a copy of the slides, they are attached as a handout as well. So again, really appreciate everyone tuning in today. Hope everyone the best and wish them continued success, and hopefully we can navigate the markets effectively enough so we can all continue to make money into the new year. Again, very much appreciating everyone being here. I see most people are dropping off. Stick around for a few more moments if there's any questions. All right, I think we are good. Thank you very much, everyone, for joining, and have a great day.